Welcome to The Deep Dive. We're the podcast where we really plunge into the most compelling ideas shaping our world.
That's right.
And today, well, we're tackling a topic that's fascinated thinkers for centuries. It's this enduring mystery of wealth. You know, how is it really created? How does it get distributed? And fundamentally, why do some people, some groups have so much while others have so little?
It's the perennial question, isn't it?
It really is. And we've dug into, a mountain of research for this one. We're aiming to give you a really sweeping look at history and economics.
And hopefully challenge a few assumptions along the way.
Exactly. It might just challenge some of your long-held ideas. Okay, let's unpack this.
Let's do it.
Our mission today, really, is to cut through some of the noise around this topic. We want to reveal the underlying forces shaping our economic reality.
Yeah, the deep structures.
Precisely. And give you a real shortcut to being well-informed about these colossal shifts in capital and inequality, looking way back through history, but also right up into the 21st century.
And I think it's important to stress right at the outset that the material we're drawing from today isn't just, abstract theorizing.
Right.
It's based on some really extensive research. We're talking decades of work, compiling vast amounts of historical data, the kind of data that, frankly, previous generations of economists often just didn't have access to.
That scale of data is crucial, isn't it?
It really is. So this deep dive, it's going to look at the facts, look at the patterns. The aim is to inform democratic debate. We're not here to push a particular agenda or take sides. The goal is really to focus attention on the right questions based on the evidence. So you, the listener, can draw your own informed conclusions about these critical issues.
That makes perfect sense. A framework for thinking based on data. So, okay, let's start by grounding ourselves. Let's look back firmly in the past.
Good place to start.
When you look at the early economic thinkers, people like Ricardo, Malthus, Adam Smith, they were observing capitalism, but it is in its really early stages, right?
Yeah, nascent, yes. And crucially, without the kind of modern statistical tools we take for granted today, or even a deep historical record to draw on in the same way.
Exactly. Take David Ricardo. He came from a family of financiers, interestingly. And his big concern, as the sources point out, was the long-term evolution of land prices and rents.
Right. He saw this trend where landlords seemed to be claiming an ever-growing share of national income.
Just by owning property, not necessarily by doing anything particularly productive with it, just owning it.
Yes. And that observation was quite powerful even without precise figures. It pointed to a dynamic where ownership itself was a primary driver of income distribution.
And that historical lens, it seems absolutely crucial for understanding where we are now.
It is, because ideas from the past still shape our thinking. Take the Kuznets curve theory, for example. This was a very influential idea for a long time.
Right, I've heard of that one. The idea that inequality sort of rises and then falls naturally with development.
Exactly. It predicted this natural decrease in inequality as societies went through advanced industrialization. It offered a pretty optimistic picture, suggesting that economic progress would eventually lift everyone, sort of automatically reducing the gaps.
A comforting thought, I suppose.
Very comforting. But what's really striking, and what our sources highlight quite strongly, is that its origins are maybe more complex. It's described as, and this is a direct quote, a product of the Cold War.
Really? How so?
Well, the argument presented is that it was, at least partly, intended to keep, quote, underdeveloped countries within the orbit of the free world. By showing them a path where capitalism eventually leads to lower inequality, it countered the Marxist narrative.
Ah, okay. So it wasn't just pure economic observation. There was a geopolitical context.
Precisely. And this isn't just some, dusty historical footnote. It serves as a powerful reminder, I think. We should always try to question the underlying assumptions, maybe even the potential political context behind seemingly neutral economic models.
Especially when those models are used to justify certain policies or predict the future, even today.
Absolutely. It encourages a critical eye when looking at proposed solutions for today's global challenges. What are the assumptions? Who benefits from this particular view?
That really does highlight how political forces and economic thought can be intertwined. And when you dive into specific historical examples, the actual dynamics of wealth accumulation can be truly eye-opening, sometimes quite stark.
They really can.
Let's consider France before the Revolution, before 1789. The sources mention rapid population growth at that time.
Yes, demographics play a role.
And interestingly, this led to stagnant agricultural wages for most ordinary people.
Yeah.
Their incomes weren't really going up.
Right, more people competing for the same kind of agricultural work, essentially.
But at the same time, land rents, the income flowing to the aristocracy who owned the land, just kept climbing.
So the gap widened.
Exactly. And this fueled, understandably, immense unpopularity for the aristocracy. It created this deep social tension, this observable pressure cooker, long before anyone had the detailed statistics to fully quantify it. You could just feel it.
A visceral sense of unfairness.
Definitely. Or, let's take a completely different context. The American South before the Civil War.
A very different and brutal system.
Here we saw an extreme form of inequality where, quite literally, as the sources put it, one half of the population owned the other half.
It's hard to even comprehend that scale of ownership of human beings as capital.
And what's key here is that slave capital didn't just supplement landed wealth. In many cases, it largely replaced it or surpassed it. It became the dominant form of capital.
You see that in the inventories and holdings of figures from that era.
Yes. Figures like Thomas Jefferson, his wealth was significantly tied up in enslaved people, far more than just land. It's a stark, brutal illustration of how wealth can be accumulated and concentrated in such a violently unequal way, even predating modern industrial capitalism as we know it.
It underscores that the form capital takes can change dramatically, but the potential for extreme concentration is always there, depending on the legal and social structures in place.
These historical examples, they really set the stage, don't they, for understanding the deep roots, the long-term patterns of wealth dynamics.
They absolutely do. They show us this isn't a new phenomenon.
But to really grasp how it all works today in our globalized, financialized world, we need to dive into some of the core mechanics, the underlying engine, so to speak.
Right, the concepts we use to measure and analyze it.
Okay, this is where it gets really interesting.
Indeed. To really get our heads around this discussion properly, we probably need to define a few key terms as simply as we can.
Good idea. Laying the groundwork.
First up, national income. Think of this simply as the total annual flow of new wealth a country produces in a year.
Everything new that's generated.
Exactly. All the goods and services produced. And this new wealth, this income, is then distributed, broadly speaking, between two main categories. There's labor, which is basically compensation for work, your wages, salaries, bonuses. And then there's capital, which receives income in the form of profits, dividends from stocks, interest on bonds or loans, and of course, rents from property.
Got it. Income split between what you earn from working and what you earn from owning stuff.
That's a good way to put it. Now, the second term is capital itself. And it's important to realize that this is much broader than just, factories and machines, what economists sometimes call physical capital.
Right. Not just the means of production.
It crucially encompasses things like residential real estate, houses, apartments. Actually, our sources suggest this makes up roughly half of all capital stock in many developed countries today.
Half? Wow, that's huge.
It is. And capital also includes what's called immaterial capital, things like patents, trademarks, intellectual property, things that generate income streams.
Okay, so land, buildings, machines, financial assets, IP. It's the total stock of owned assets that can generate income or be traded.
Precisely.
Yeah.
And here's a really crucial shift that the research emphasizes, something that dramatically changes the modern landscape compared to, say, the mid-20th century.
What's that?
Today, in most developed countries, nearly all of the national wealth, the total capital stock, is held in private hands.
As opposed to being owned by the state.
Yes. Think about the post-war period. There was often significant state ownership of industries, infrastructure, housing. That's much less the case now. Private wealth owned by individuals, families, corporations accounts for almost the entirety of national wealth.
That feels like a profound change with big implications.
It has huge implications for how wealth is controlled, how it's distributed, and how it generates income. And that brings us to the third key concept, the capital income ratio, often denoted by the Greek letter beta.
Beta. Okay, what does that measure?
It's simply the ratio of the total stock of capital, all that wealth we just talked about, relative to the annual flow of national income.
So how many years' worth of national income does the total capital stock represent?
Exactly. It essentially tells us how important capital is in the overall economy, how much accumulated wealth is sitting there relative to the income being generated each year.
Okay. And does this ratio stay stable?
That's where it gets fascinating historically. The research shows a distinct pattern, particularly in Europe and also Japan. It follows what's described as a U-curve.
The U-curve.
Yes. Beta was very high back in the 19th and early 20th centuries, maybe 6 or 7 years worth of national income. Then It fell dramatically, really plummeted during the period of the World Wars and the Great Depression due to physical destruction, inflation, nationalizations, and regulatory changes.
So the importance of capital relative to income decreased?
Significantly. But since around the 1970s or 1980s, it's been rising again, quite steeply in many countries. And now, in several European nations, it's approaching or even exceeding those high levels seen before World War I.
Wow. So capital is becoming relatively more dominant again, just like it was over a century ago.
That's what the long-term data suggests, a return to a very high capital income ratio.
So, if I'm tracking this, we have national income being split between labor and capital. We have capital itself as a broad stock of assets, mostly private now. And we have beta, the capital income ratio, showing a U-curve, meaning capital's relative importance is rising again.
You've got it.
This seems to lead us towards understanding how the share of income going to capital is determined.
Exactly. And this brings us to what the source material calls the first fundamental law of capitalism. It sounds grand, but it's actually more of an accounting identity.
Okay, break it down for us.
It states that the share of national income that goes to capital, which we denote as alpha, is equal to the average rate of return on capital, symbolized as R, multiplied by that capital income ratio we just discussed.
So alpha equals R times beta.
It
Beta?
equals R times beta.
Let's unpack that in plain English. Alpha is capital's slice of the national income pie.
Right.
Beta is how big the total stock of capital is relative to the economy's annual output. And R is the average percentage return that capital generates each year, like the average interest rate, dividend yield, profit rate, rent yield, all combined.
Exactly. It's the overall rate of return earned, on average, across all forms of capital in the economy. So, this first law basically tells us something quite intuitive when you think about it.
Which is?
The bigger the overall pool of capital in an economy relative to income, that's beta, and the higher the average return that capital generates, that's R, the larger capital's total share of the national income pie, alpha, will inevitably be.
Okay, it connects the stock of wealth, its return, and its share of the income flow. It's an identity, like you said. It have to be true by definition.
Correct. It's an accounting identity. But it's an incredibly useful one. It provides a powerful lens for seeing where wealth actually flows in an economy and how that flow might change if either R or beta changes.
Right. It gives us the variables to watch.
Precisely. And this identity, AE-RXE, sets the stage perfectly for what is arguably the central and often the most concerning concept in this whole analysis.
Okay, I'm ready.
It's the inequality symbolized as RG.
R greater than G.
Yes. Where R is that average rate of return on capital we just discussed, and G represents the overall growth rate of the economy, the growth rate of national income.
So the return on owning stuff is greater than the growth rate of the whole economy.
Yes. The core argument presented is that over long periods of history, the rate of return on capital R has persistently and distinctly tended to be greater than the rate of economic growth.
And why is that specific inequality, RG, so important?
Because, as the research argues, this is a fundamental, powerful force pushing towards a more unequal distribution of wealth.
How does that work exactly?
Well, think about it. If wealth that already exists, capital, grows at a rate R, says 5% per year, and the overall economy, and average incomes within it, grows at a slower rate, G, say 1–2% per year, what happens over time?
The wealth that started out large just gets relatively larger compared to everything else. It pulls away.
Exactly. Wealth accumulated in the past automatically grows faster than output and wages. Inheritance and existing fortunes tend to dominate wealth, originating from savings scraped together from labor income. It creates a dynamic where capital begets more capital, outpacing the growth that benefits labor income more broadly.
To really bring this home, are there examples?
The source material actually draws on some interesting literary examples to illustrate this, from writers like Balzac or Jane Austen.
Grounding it in social observation from the past.
Right. Think of characters like Balzac's Père Goriot, or perhaps Colonel Brandon in Austen's Sense and Sensibility. These characters, often living off inherited wealth or investments, could easily expect annual returns of, say, 5% or perhaps even more from their capital.
Which was significantly higher than the likely economic growth rate back then.
Absolutely. Their fortunes could grow substantially faster than the average income in society, often allowing them to live very comfortably without needing to work, or even just maintain their wealth's relative position with minimal effort. It demonstrates a world where accumulated wealth itself generates more wealth almost on autopilot, reinforcing existing hierarchies.
So it's not just some abstract economic formula. It reflects a social reality observed for centuries.
Precisely. And so what for today, the crucial point is that this isn't just about historical figures in novels. The argument is that this underlying dynamic, RG, is a fundamental engine behind the accelerating wealth disparities we observe globally right now.
Because capital returns continue to potentially outpace economic growth.
Yes, it makes it inherently harder for income from labor, even for highly skilled workers, to catch up to the returns generated by large pools of existing capital, regardless of individual effort or talent. The starting point matters hugely.
That paints such a vivid picture, how capital, through this RGE mechanism, could just perpetuate and even amplify itself over generations, essentially generating wealth from wealth.
That's the core of the dynamic.
And you mentioned earlier, it seems like we're seeing echoes or maybe even a resurgence of this dynamic today. The sources talk about a new patrimonial capitalism. What exactly does that mean?
Right, patrimonial capitalism refers to a society where inherited wealth, patrimony, plays a dominant role in the structure of wealth and society, where being born into wealth is a primary determinant of one's economic standing.
As opposed to a society based more purely on merit or labor income.
Exactly. And the argument is that after a period in the mid-20th century where inheritance perhaps became less dominant due to wars, high taxes, and strong growth, we are now seeing a comeback. This idea of new patrimonial capitalism essentially means that inherited wealth and the returns generated by existing capital, fueled by RG, are again becoming the primary drivers of wealth accumulation at the top.
So it's suggesting that wealth from the past is increasingly overshadowing wealth created through current work or innovation.
That's the concern, yes, that the returns on capital are becoming so significant relative to growth that they often outweigh income derived from labor, even very high salaries. It's certainly a structural shift worth paying close attention to, especially given that surge in private capital's importance, that rising beta, since the 1970s.
Okay, so we have these foundational concepts: the capital income ratio, beta, the return on capital, R, economic growth, AG, and this crucial inequality, RG, driving divergence. With that framework in mind, how has this inequality actually played out? How has it manifested and maybe changed across different parts of the world? Let's shift our focus now to inequality in action, looking at both income from labor and the ownership of capital itself.
That's a great transition, because the story isn't uniform across the globe. The research highlights what could be called two worlds of inequality, or at least two very different trajectories, particularly when comparing Europe and the United States over the last century or so.
Two worlds. Okay, tell us about the first one, Europe.
Let's take Europe's 20th century story first. It's quite dramatic. You had the immense shocks of World War I and World War II, cataclysmic events that destroyed vast amounts of physical capital and wiped out fortunes through inflation and destruction.
A forced leveling in a tragic way.
In many ways, yes. But alongside that, and perhaps more sustainably, you had the deliberate implementation of highly progressive tax policies.
High taxes on the wealthy.
Very high by historical standards, yes. We're talking about top marginal income tax rates and, crucially, significant estate or inheritance taxes. In the period from roughly 1914 up to around 1980, top rates often exceeded 20–30% and sometimes went much higher, especially on very large incomes and inheritances.
And the effect of these policies?
The data suggests they dramatically reduced the concentration of wealth at the very top. They limited the ability of large fortunes to perpetuate themselves and grow exponentially through that RG mechanism.
So taxes acted as a brake on capital accumulation at the top.
Essentially, yes. And this combination of war-related shocks and deliberate policy ushered in an era, roughly the post-war decades, where, according to the source material, something historically unprecedented happened.
What was that?
For perhaps the first time in history, study, work, and talent paid better than inheritance.
Wow. That's a profound statement.
It really is. It marked a profound societal shift, suggesting that income from labor, driven by education and effort, became a more reliable path to prosperity than simply inheriting wealth. It was a change driven partly by tragedy, but significantly by intentional policy choices regarding taxation and the role of the state.
What a stark picture of mid-20th century Europe. Now, you said two worlds. What's the contrast? The American trajectory.
Yes, the American story, particularly since the 1970s or 1980s, presents a striking contrast. While Europe saw a reduction and then a slower reemergence of high wealth concentration, the U.S. has experienced a dramatic rise in income inequality, particularly at the very top.
Driven by what, mainly?
A key factor highlighted is the emergence of what the research terms super salaries.
Super salaries, as in extremely high pay for top jobs.
Exactly. We're talking about the compensation packages for top executives of large firms, CEOs and the like, which have reached historically unprecedented levels, far outpacing wage growth for the vast majority of workers.
It's certainly something you read about a lot. But how does that fit with the RG idea? Isn't this about labor income, not capital returns?
That's an excellent question. While RG primarily explains the divergence of capital wealth, the rise of super salaries addresses the inequality within labor income itself. And it raises important questions about why these salaries have grown so large.
Is it just that these executives are incredibly productive, the market valuing their unique skills?
Well, that's the traditional explanation, often referred to as the theory of marginal productivity. The idea that your pay simply reflects your contribution, your skill, your productivity.
Makes sense in theory.
In theory, but the sources we're drawing on suggest this explanation isn't fully convincing when you look at these extreme top earners. The research indicates that factors beyond individual productivity seem to be at play. Things like bargaining power.
Bargaining power. How so?
The ability of top executives, often sitting on compensation committees or influencing them, to negotiate very favorable pay packages for themselves. It also mentions luck, being in the right place at the right time, perhaps leading a company during a general market upswing.
So it's not just about pure talent or effort driving these massive paychecks.
The argument is that talent and effort are surely necessary, but they might not be sufficient to explain the sheer scale of these super salaries. Institutional factors, corporate governance structures, and even social norms about what's considered acceptable pay seem to play a significant role.
And does policy connect to this, like the tax policies you mentioned in Europe?
Very much so. The research suggests a strong correlation, particularly between the decline in top marginal income tax rates in Anglo-Saxon countries like the US and UK since the 1980s, and the subsequent explosion of these super salaries.
How does that connection work? Lower taxes encourage demanding higher pay.
The theory proposed is that when top tax rates are very high, say 70–80%, there's less incentive for executives to bargain aggressively for extremely high pre-tax pay, because a large chunk would be taxed away anyway. When top rates fall significantly, the incentive to negotiate for that extra million or 10 million increases dramatically. It becomes much more worthwhile personally to push for higher compensation.
That's a really counterintuitive insight, challenging that simple idea that the market always perfectly rewards merit in isolation. It suggests the rules of the game, like tax policy, heavily influence the outcomes.
Exactly. It suggests the system itself, the institutional context, allows or even encourages some individuals to capture enormous compensation packages, perhaps somewhat decoupled from purely objective productivity metrics, which are often hard to measure anyway in complex organizations.
And the numbers really bear out this divergence between the US and Europe, right?
They do. The difference in top income shares is quite striking. The research shows that the share of total national income going to the top 1,000 of earners, the top 0.1% in the U.S., increased dramatically in recent decades.
How much?
It went from around 2% in the 1970s to nearly 10% in recent years, a five-fold increase in their slice of the pie.
Wow, nearly a tenth of all national income going to just the top 0.1%.
Yes. Now compare that to continental Europe and Japan. While they also saw some increases in top income shares over the same period, the rises were significantly smaller, much less dramatic.
So it highlights a clear divergence. Different economic structures, maybe different social norms about inequality, different policy environments, all leading to vastly different outcomes, especially for those at the very, very top.
Precisely. It shows that globalization or technological change, while potentially contributing factors, don't necessarily lead to the same inequality outcomes everywhere. Policy and institutions matter immensely.
Okay, so that gives us the historical context, the core mechanics like RG, and a picture of how inequality has played out differently, especially comparing Europe and the US with its super salaries. But what does this all mean for us now and looking forward? Given everything we've discussed about these powerful, often diverging forces, what are some of the most significant ideas emerging from this research about how societies might actually manage or perhaps transform wealth inequality in the 21st century? So what does this all mean?
That is indeed the million-dollar question, or perhaps the multi-trillion-dollar question, given the scale of wealth we're talking about.
Probably.
The research doesn't just diagnose the problem. It also explores potential avenues for policy and reform, always emphasizing the need for democratic debate around them. One key idea that receives significant discussion is the possibility of a progressive annual tax on individual wealth.
A tax on the stock of wealth itself, not just the income it generates.
Exactly. A tax levied each year on the net worth of individuals above a certain threshold. And the core purpose proposed here is actually twofold. It's not solely about financing the state, although it certainly would generate revenue.
What's the other purpose then?
Perhaps more fundamentally, it's presented as a tool to regulate capitalism, to put a brake on the potentially indefinite, spiraling increase of wealth inequality driven by that RG dynamic we discussed.
So to stop wealth concentration from reaching extreme levels.
Yes, and also, very importantly, to promote democratic and financial transparency. A wealth tax inherently requires knowing who owns what, which is often surprisingly opaque currently. It would shed light on the true distribution of wealth.
How might such a tax work, practically speaking? Are there suggested rates?
The book explores hypotheticals. You could imagine, for instance, a system with quite high exemption thresholds, so it only affects the very wealthy. Maybe 0% tax on net assets below, say, 1 million euros, then perhaps 1% per year on wealth between 1 and 5 million euros, and 2% per year on wealth above 5 million.
And maybe even steeper rates for billionaires.
Potentially, yes. The rates could be designed to be more steeply progressive at the very top, reflecting the view that extremely large fortunes benefit most from societal infrastructure and stability, and their concentration poses the greatest challenge to democratic equality.
It sounds logical in theory, but what about the challenges? Wouldn't wealthy people just move their money elsewhere?
You've hit on the major unavoidable challenge: international tax competition and the existence of tax havens.
Right. Capital is mobile.
Extremely mobile in today's world. For a global wealth tax, or even a regional one, to be truly effective and prevent capital flight, it would absolutely require a high level of international cooperation and regional political integration.
Countries would need to agree to implement it together and share information automatically.
Precisely. Automatic exchange of banking information, coordinated tax policies, it's a monumental global governance challenge. Without that cooperation, individual countries trying to implement a significant wealth tax might just see capital flee to lower tax or no tax jurisdictions.
That international cooperation aspect seems like a huge hurdle. It makes you wonder if our current global institutions are really equipped for that level of coordination on something so sensitive.
It's a valid question. The research acknowledges this is a major political obstacle, requiring significant political will and potentially new forms of international governance. But it frames the wealth tax not just as a revenue tool, but as a necessary regulatory mechanism for 21st century capitalism.
Okay, so the wealth tax is one big idea, albeit with big implementation challenges. But beyond direct taxation of capital, what other forces or factors does the research highlight as shaping global wealth distribution today, and what are their implications?
Well, another fascinating and often complex factor discussed is immigration.
Immigration. How does that connect to wealth inequality?
It's presented, particularly in the context of the United States, as a kind of social mortar. It's argued that immigration can make existing inequalities seem more politically and socially bearable for many.
How so? Because immigrants often start from a lower baseline.
Exactly. Many immigrants, even if they face significant challenges and lower wages compared to native-born populations, often perceive themselves as being on an upward trajectory compared to their situation in their home country. This experience of upward mobility, even within an unequal system, can potentially lessen social tension around inequality itself.
That's an interesting perspective. It acts as a kind of safety valve, perhaps.
In a sense. And it also represents a powerful, though often politically contentious, mechanism for global redistribution, allowing individuals born in poorer countries to significantly improve their economic standing by moving to wealthier ones. Of course, this also raises complex questions about brain drain, integration, and the impact on wages in the host countries.
Absolutely. Okay, what else?
Another crucial factor, especially relevant in Europe but also elsewhere, is public debt.
Government debt. How does that play into private wealth?
It creates a strange paradox highlighted in the research. Many developed countries, especially in Europe, have very high levels of national wealth. Remember, that's mostly private wealth now. But at the same time, their governments are burdened by high levels of public debt. So you have immense private riches alongside relative public poverty.
And the consequence of that?
One major consequence is that governments end up spending a significant portion of their budgets simply paying interest on that debt. The sources point out situations where governments spend more servicing their debt than they do on crucial public investments like higher education.
Wow. So money that could be invested in universities or research is going to bondholders instead.
Essentially, yes. This dynamic shifts resources away from public investments in human capital, infrastructure, and innovation, things that could potentially boost growth and opportunity more broadly, and redirects them towards servicing past debts, often held by wealthy individuals or institutions. It can indirectly exacerbate inequality by limiting the state's capacity to invest in leveling the playing field.
So public debt isn't just an accounting issue. It actively constrains the state's ability to act and potentially counter inequality.
Exactly. And speaking of the state's role, we have to mention the social state itself.
Public services, welfare systems.
Precisely. The research emphasizes that the growth of the fiscal state, the state's capacity to tax and spend throughout the 20th century, was what enabled the development of the social state. Think public pensions, universal healthcare systems, public education.
Things we often take for granted now in many countries.
We do. But this was a crucial modernization process. It fundamentally altered the relationship between citizens and the state, providing a safety net and opportunities that profoundly reduced poverty, improved health outcomes, increased education levels, and generally lessened the harshness of pure market outcomes for the vast majority of the population. It was a massive force against the extreme inequalities of the earlier era.
But you said it faces challenges.
Yes, the social state faces ongoing and significant challenges today. Aging populations put pressure on pension and healthcare systems. Rising costs, especially in healthcare, are a constant issue. And the pressure of globalized capital and tax competition can make it harder for states to raise the revenue needed to sustain these systems. Maintaining and adapting the social state is a key battleground for inequality in the 21st century.
It really sounds like a complex web, doesn't it? All these interconnected issues, the RG dynamic, taxation choices, corporate governance, immigration, public debt, the future of the social state, history, economics, politics, social norms, all tangled together.
It is definitely a complex web. And the research makes it clear that these aren't just abstract economic forces operating in a vacuum. They are shaped by policy choices, by political battles, and by societal values. They directly impact the quality of life, the opportunities available, the sense of fairness for people all around the world.
So these aren't just academic debates for economists in ivory towers. They're discussions that profoundly affect the everyday lives and the future prospects of literally billions of people.
Absolutely, yeah. And that's why understanding the dynamics is so important. If we connect this back to the bigger picture, the key takeaway is that the future dynamics of wealth and inequality are not inevitable. They aren't predetermined by some iron law of economics.
They depend on choices.
Profoundly. They depend on, as the source material puts it, how societies view inequalities and what kinds of policies and institutions they adopt to measure and transform them. It really comes down to continuous critical scrutiny, open democratic debate, and the political will to make choices. These are decisions we make collectively as societies.
What a journey we've taken. From Ricardo and Austin to super salaries and global wealth taxes, it's been a deep dive into this incredibly complex landscape of capital, inequality, history, and policy.
It certainly covers a lot of ground.
And it feels clear that understanding this history, these mechanics, really does provide you, the listener, with maybe not a crystal ball, but at least some modest keys to understanding the future, and certainly to making better sense of the economic headlines and debates you encounter every single day.
Precisely. It equips you with a framework. And perhaps the ultimate challenge posed by this research, looking at the 21st century, isn't just about figuring out how to foster economic growth, as important as that is.
What is it, then?
It's about the larger project of building a just social order, one based on principles of common utility, shared benefit. An order that can find ways to effectively regulate the highly globalized, increasingly concentrated form of patrimonial capitalism that seems to be emerging.
Regulating it democratically.
Yes. And that calls for continuous critical thinking, democratic engagement, and a willingness to adapt institutions. Because, as one of the final thoughts in the material reminds us, technology and the market are powerful forces, but ultimately they operate within the rules we set. Quoting loosely, technology, like the market, has neither limits nor morality in itself. It's up to society to provide the direction and the ethical framework.
A powerful closing